Just recently, two banks collapsed in the United States, and the future of the large Swiss bank Credit Suisse is yet to be determined. These events prove that even regulated banks are not 100% safe, and that if certain risks materialize, the bank can default.
The ripple effects from the collapse of Silicon Valley Bank on Friday are being felt across the world.
Many investors are concerned about the current banking crisis and how it can impact the safety of their P2P lending portfolios. In this video, we will dive deeper into how banking works in the P2P lending industry and what can be done to protect your money. Banks are crucially important for the P2P lending space, and a systematic failure of banks could cause significant losses to investors. When investing in loans, your money will be transferred through multiple bank accounts until it is used to fund the actual loan. First, you must top up your investment account by transferring money to the platform's bank account. If you invest in short-term loans or consumer loans, your money will be sent to an intermediary bank or directly to the lender, depending on the investment structure and country where the loan is being issued. If you invest in business loans via crowdfunding platforms, your money is often sent directly to the borrower seeking to fund its projects. As you can see, your money flows through at least 3 to 4 bank accounts in various jurisdictions. While banking regulation is relatively unified in Europe, the banking industry in Vietnam, for example, can be different. When it comes to P2P lending, your goal is to move your funds to the borrower's bank account as quickly as possible to generate interest. As you might know, there is no interest if you just keep your money sitting in a platform's bank account. Practically speaking, most of the banks in the P2P lending industry are meant to transfer your money rather than safeguard it. If a bank within this chain collapsed, it would not be great, but it should not impact your portfolio as long as most of your funds are fully invested. It's common practice that every stakeholder, either a platform or a lender, has multiple bank accounts to quickly move funds between accounts should one of their partner banks get into trouble. This is standard business practice for lenders purely as a redundancy, and most legitimate P2P lending platforms hopefully follow this practice as well. Now, we should mention that as soon as you transfer funds from your private account, you are losing the benefit of the deposit protection scheme, which protects up to 100,000 euro per client if you're banking in Europe. So after we have established some basic understanding of the banking network required to participate in P2P lending, let's review some of the requirements followed by the platform's banking partners. It's important to highlight that when you send money to an account in the platform's name, you are not always sending it to a bank. Many platforms are using e-money providers, which are essentially tech companies that help to facilitate electronic money transfers. Many of those e-money institutions provide better products and easier platform onboarding, making it more convenient than using banks. It's useful to know the difference between banks and electronic money institutions, as banks are way more regulated. If a company wants to apply for a banking license in Europe, it has to be approved by the European Central Bank and the local financial regulator. It also has to follow the rules of the European Banking Authority. The minimum capital requirement is much higher than for e-money institutions, and the biggest perk is certainly the deposit protection scheme, which covers deposits of up to 100,000 euro per client. Furthermore, banks can hold deposits, issue loans and credit cards, and offer wealth management services as well as an interest-bearing account. E-money institutions cannot offer those financial services. The license is issued by national financial regulator, and the capital requirements are significantly lower. There is no deposit protection scheme available, and those institutions cannot hold your money. Instead, they need to keep your funds in licensed banks. This can actually become an issue, as e-money providers are not required to reveal which partner banks they are using to store your funds. So if you read an article about a troublesome local bank, you don't know if you have indirect exposure to this bank via P2P lending platforms. Here are some of the popular P2P lending platforms and the accounts from banks or institutions they use. You can clearly see which platforms have partnered with banks and which use e-money institutions. Some licensed providers reveal at which bank they store clients' funds, others just mention that they store them at trusted European credit institutions. These credit institutions must be extremely trustworthy, since the e-money providers cannot reveal them publicly on their websites. If you don't have uninvested funds on the P2P lending platform that you are using, it doesn't concern you that much, but it's certainly something to keep in mind. Now, regardless if the banking partner is a licensed bank or a payment institution, the following risks are valid for both platforms. The fact is that banks are deploying your money to generate revenue. You, as a client, are barely aware of the trades and the risk they take on, as you mainly rely on the deposit protection scheme. If you keep an amount of money with e-money institutions or invested in P2P loans, you're losing the right to be compensated should the company default. Outside of your investments, you can mitigate risks by opening multiple bank accounts in various jurisdictions or even holding your funds in various currencies to protect your personal funds from bank defaults. After you send money to a P2P lending platform, you lose control over it, meaning you have to trust the stakeholders to do proper risk management to mitigate the potential risks that could materialize. So, should you be worried about the banking crisis impacting your P2P lending portfolio? Well, I think that if a bank within the banking chain used to transfer your funds to the borrower defaults, you would not suffer a significant loss of your capital. Most investors keep their money invested at all times, and you would have to be really unlucky if a bank defaults just as you are deploying or exiting a large amount of money. What could, however, become a more significant issue would be the default of a bank that is used to fund the operation of the platform or the lender. If those companies don't have money to operate, it could become problematic, as it would significantly increase the platform risk. On the other hand, many platforms are financed by lenders for the purpose of funding their loan books, so an additional cash injection could mitigate this negative scenario. Either way, I think that there are more likely risks to keep in mind than the risk that a defaulted bank would cause you losses in the P2P lending space. As with any risk mitigation strategy, it comes down to the platform's track record. There's plenty of information on P2P Empire to check how platforms behave during a challenging time. If platforms manage to protect your funds during turbulent economic periods, it's a good sign. If platforms treat investors as dumb money, then the risk obviously increases. If you stick to best rated P2P lending platforms with a good track record and low amount of funds in recovery, chances are higher that their risk management approach would shield you from potential risks, including banking risks. At the end of the day, lenders and platforms have to use banks to operate their businesses. It's also in their interest to ensure that they have a good system in place to protect their operations. So that's been my take on how this scenario would potentially play out. If you appreciate this type of content, hit the like button and subscribe to the channel to not miss out on future videos. Also, let me know in the comments below whether you have changed your investment strategy or money management approach due to the recently defaulted banks. I'm curious to hear your thoughts on this topic. Thanks for watching, and I will catch you in the next video.